Hi everyone, and welcome to this new edition of Learning Simplified. In this session, we are going to understand more about position accounting. So what's going to be the agenda for these sessions? Number one, we understand when is position accounting passed, how is it passed, and once we know how it is passed, we will soon come to know why is it passed. So let's first understand when is position accounting not passed. So whenever there is no difference in currency of the debit and the credit in an accounting, position accounting will not be passed. So let's take an example where we are debiting GL1 with 100 USD and crediting GL2 with 100 USD. Or when we are debiting GL1 with 5,000 INR and crediting GL2 with 50,000 INR. So in both the cases, the debit and the credit currencies are the same. Either both of them are foreign currencies or both of them are local currencies. So in this case, INR or the Indian rupee is my local currency. So obviously in both these examples, no position accounting entry will be passed. So when is position accounting passed or how is it passed? So whenever there is a difference in the currency of the debit and the credit entry. So let's take an example. Debit GL1 100 USD, 50,000 is the local currency, and crediting GL2 with 50,000 INR. A typical example of this could be when you are having a charge for a transaction. The charge you want to collect in INR or the local currency, but the debiting of the customer account happens in USD because he or she happens to have a USD account. So in such a scenario, you will have a mismatch of the debit and credit currency. Now what happens here is that the LCY or the local currency is balanced. So obviously the balance sheet which is taken in LCY will be balanced. Now in FCY, it is not balanced because USD 100 is debit. It's hanging in the debit balance. So a position accounting is passed immediately online real time. So in this case, a position account is created for that USD account and a contra entry is passed with 100 USD. Because we cannot have three entries, we just pass another balancing entry for position equivalent for the LCY alone. Now with these two pairs, both my LCY is balanced as my FCY is also balanced. So this is the purpose of position accounting, such that my foreign currency accounting gets balanced, and if required for a foreign currency balance sheet, also it will be balanced. Now let's take another example where there is a difference of currency. Now in this case, the debit and the credit both are in FCY but in different FCY. So you're debiting 100 USD and crediting 80 euro. So the INR also comes the same based on LCY averaging. So here, two pairs of position accounting will be passed. One for 100 USD, you will be crediting it because the original entry was a debit. And for 80 euro, you will be debiting it because the original euro entry was a credit. So post these three pairs, my USD, euro, INR, everything will be balanced. So I think now it gives you a good idea as to why position accounting was done. Now let's take an example of two transactions. The first transaction of 100 USD hitting the position GL for 100 USD and another transaction for GL3, but this time 50 USD. So there are two transactions done. So if you look at this, the position GL001 holds a net balance of 100 plus 50. Ideally, sorry, this should be 50 USD and not 100. So the position GL now reflects the net balance of all the transactions made in foreign currency. So now you would have got a good idea as to why position accounting was done. The position GL reflects the foreign currency position in the balance sheet and represents the potential economic exchange rate risk in the respective currency. And of course, it helps with the balanced balance sheet in foreign currency. So hope this gave you a good insight on position accounting. And in the next video, we are going to understand more about currency revaluation. Thank you.